Okay, welcome everybody. Today, I know we're talking about trading indicators, so we're going to look at some technology, proprietary strategies, and technology that we develop for trading options in a way you've probably never done so in the past. It's called the Risk Thermal Indicator, or RTI for short, and we have a group of what we call underground options traders using our technology. We can automate your options trading, take a lot of the heavy lifting out of the equation for you. These are pre-built option strategies and spreads. We're looking at stock indexes, trading in all directions, but primarily we're going to look at non-directional strategies. And actually, the presentation prior to this is probably a good segue. So some of what he spoke about, we're going to touch upon that as well. But we have a unique feature, one-touch trade alerts, and I'll show you that too. We'll go ahead and get started, but first let's take care of some of the risk disclosures. So we're trying to make money as prices move up and down. And with that, of course, there's always risk. So do take a moment and look at that risk disclosure, please. Remember, all trading should be risk capital. Past performance is no guarantee of future results. We've all heard that before. So an algo solution to options trading, there's algo generated options trades. I mentioned pre-built spreads, one-touch trade alerts. We'll look at the RTI, that's automated risk and profit management. And we're going to do this with non-directional strategies, maybe one that you've heard of, and I think one that you have not. We're going to look at trading the chop, call it the chop bucket here. So what do you do in these situations? And you don't want to end up like this poor chap here struggling with orders. So we're going to try to help you become more like that robot there, trading with confidence. A little bit about who we are first. We are AltaVest, and we've been doing this since 1997. We're a registered introducing brokerage firm. That's yours truly there on the trading floor a few years back with some of our options traders on the trading floor at the CME. So we've been doing this for decades now. And you may have seen some of our presentations in the past, and some of the other vendors we're listed with, the CME Group and so forth, Market Watch. We get quoted often in Market Watch. Here's a comment just from a few days ago. You can see here, AltaVest. So just to let you know, we have a nice footprint, and we, of course, are regulated by the NFA and CFTC, and we're located out in beautiful sunny Southern California, usually sunny, and it is this summer, that's for sure. And we're regulated with the CFTC and NFA. So we are not in the securities industry. We're in a separate industry, but there's a lot of similarities and I think some advantages as well. And I'm going to show you all about that in just a second. So I think having traded millions of these contracts over the years, I think you might qualify us as somewhat of an expert in this space, trading millions of futures and options contracts. And the reason I mention that would be, I think that experience can help you. We don't need you to figure everything out by yourself, by this poor chap here in the basement. So use our trading solutions that have been built with experience and decades of input, development, quite frankly, by industry veterans over the years. And who am I? So who's this guy chatting here? I'm Erik Gebhard. I've been doing this about 30 years, licensed back in 1991. And I have my BS in Business Administration from the University of Southern California. So USC, go Trojans. And a little bit, maybe some of the presentations you've seen, just thought I'd throw them out there. So maybe you've seen us in the past. If you're familiar with us, we might have something a little bit different than what you've seen. And sometimes people ask, how did you get started? So I won't go too deep into this, but I did find my textbook from my finance course, one of the courses at USC in business school, and we were looking at financial instruments and modeling and doing Black-Scholes and using a lot of statistics and this and that derivative of that and this, and it's a very complicated approach to trading, I can tell you that. But nonetheless, it did pique my interest, and we were looking at crude oil prices doubling and gold prices had jumped. So that was the backdrop in which I was learning, and that's how I sort of, you could say, piqued my interest there. I got started in the securities industry and eventually thought securities futures would be a little more interesting. And of course, that's where I have been since. So with the introduction out of the way, I'll go ahead Let's look at the 3 common barriers for traders and how many of you can relate to these. Let's take a look. Day trading, it's not that easy. Everyone's a genius in a bull market. And I think we're all familiar with that comment and quote, but I think there is some truth to it. Look at this here. 2/3 of adults have been investing in less than 3 years are using social media to trade stocks with. This always strikes me as very odd. People who really have no expertise in anything um, giving advice and other people taking it. So I don't know. I think that's a recipe for disaster. It's sort of like this cartoon here. There's the bull telling the Wall Street guy here to sell me a story, stock market fairy tales. And this one cracked me up. It's from social media, AMC to the moon. So they had a party here, some nightclub or day club or I don't know what, beach party, pool party, and they're pushing these meme stocks, AMC. So you have to laugh at that. And this one made me chuckle, so I throw it out there for you. So maybe you've seen that before. But really, day trading, there's, according to some studies, less than a 1% success rate. Journal of Financial Markets, for example, says here that they did a study from, this is back in, not too far ago, 2014, not too long ago, but it says less than 1% of the day trader population is able to predictably and reliably earn positive abnormal returns net of fees. So I think there's a lot of truth to that, although the markets I think can be beaten. It is I think some people prove it, but you do need a process and you need technology. And a lot of the presentations I've seen and some of the ones I saw today, for example, these people have some methods and processes that are repeatable. You have to have a process. You cannot just end up like these TikTok people just throwing money at the wall. So another thing to consider is a lot of these times people are looking at day trading and thinking they've got to sit in front of a wall of monitors like this guy. But let's face it, most of us are working and have other responsibilities. You cannot sit in front of that screen all day. Now, number 2, how about this hurdle, beating the market? Can you really beat the market? Well, maybe, maybe not, but you have to be perfect. If you're just buying stocks, you've got to be perfect with all these different things, picking the correct market, direction, strategy, your entry timing and price. Then of course you have to manage all those trades once you have them on. That might be the most important thing of all, is really your exit point. And I think people often forget that. And here's a interesting piece from Mark Skousen. He's a famous economist. He talks about basically randomness, monkeys beating the market. And it says monkeys outperform the index by 1.7%. 96 of the 100 monkey portfolios beat a generic cap-weighted index. So fascinating stuff there. So if you're looking for a hedge fund manager, maybe we got to look to this chap or gal. I'm not sure which is which. Anyway, and then look at this too. Random darts are beating hedge fund stars. And this is just from a couple years ago, but I think there's some sentiment here that is probably timeless, which is most hedge funds, most mutual funds, you name it, any kind of money management or money manager, probably not beating the general stock market. And part of the problem here is emotions. How many of us can relate to this? And this guy here, control your emotions. Remember here, Ed Sequoia, he's a market wizard from the book Market Wizards. He's a famous systematic trader. It can be expensive convincing the markets that you are right. So you don't want to end up like this guy here. And we're going to hopefully help you avoid that. We're going to get into a demo in just a minute. But there's a lot of noise. How do you navigate through all the noise? You've got the bulls jabbering and the bears yammering, and you've got CNBC and whoever else. Everyone's got an opinion and a narrative, but it's really not helpful. I don't think any of us would ever agree that it's actually helpful. And here's the emotions. I thought this was a great piece here, the cycle. You start off optimistic, then you get euphoric when you have some big winners. Then you start to give back the winners, have some losers. Now you're desperate, you're panicking, you raise the white flag. Now you're depressed, you're pounding the ground, and maybe there's a little hope, now a little relief, and now you're optimistic again. So we want to avoid that roller coaster. You don't want to get involved with confirmation bias and anchoring bias and recency bias. And we won't go into all that. That Motley Fool has a good piece on that. So number 3, how about the third element here, or third hurdle? Remember this, you're competing against algos and machines, not just people like yourself sitting behind your desktop or on your app or phone. So they're dominating the marketplace. Bloomberg here says robots are outwitting humans on their investment picks. That's no surprise. So really, it's revolutionary trading. You've got kind of the antiquated traders here back then, and who knows, trading pieces of, I don't know, iron and dirt and clay and whatever else, bone. And now here we are, we have machine trading. And this is kind of a grainy old video I took with a beat up old digital camera years ago on the trading floor. But here's what it used to look like. And now this is what it looks like. So it went from all that to this. And remember, emotionless, they run automatically, built-in risk and profit controls. So really the idea would be, how can you use all that and use that automation and technology and those algos to your advantage if you're trading options? How can you use that to compete in this new paradigm, this new landscape? So we're going to look at here in part 4, automating your options trading, and we're going to do a specific type of trading. We're not just throwing darts at the wall. We have a real niche here, and it's what we call, no other word for it, it's a bit of a weird strategy, and I think you're going to want to know about it. And these are strategies for up, down, and non-directional stock index futures markets. So we're trading options on stock index futures. We're going to focus on the non-directional strategies right now. And we're going to look at what we call the risk thermal indicator as our unique piece of the puzzle. But why? Here's the question we always get. Why are you focusing just on the stock market indexes and not individual stocks? Well, I think the answer is somewhat obvious, but let's review. Less volatile. Indexes may have a move of 3% in a day, and that's a really big move. In fact, the last yesterday and today, we didn't even get, we didn't get up to 3% on the S&P. I think the Russell did, but that's okay. But individual stocks can move 10, 20, 50% in a day. Even the big cap stock can move 10%, 20% in a day. Proprietary strategy. So we have a strategy I'm going to show you using the RTI indicator, and it's really not available with stock options. It's not something that can be done, and I'll show you why. And then one market or two markets, so you can follow just one or two or three stock indices. You don't have to track thousands of different securities. I mean, there's over 6,000 or 7,000 different tradable, maybe even more than that now, securities. And here's an example. Huge percentage moves. I mean, here's Tesla as an example. Of course, you can use any other, security if you wanted, but in 1 month you're up 112%, and you're down 35%. Then you have all this chop, and so it's a very difficult thing to navigate that landscape. Now let's look real quickly at insurance companies. How do they make money? I think we all know. We end up like this poor guy here. We pay them a lot of money, so they take our money, and they assume that risk that we don't. Just a risk transfer mechanism. They're essentially selling time, but they do insure themselves from that risk by hedging, and they're consistent and they're patient and they have a plan, and they're looking at probabilities, and they're only looking at math and favorable long-term statistics. They're looking at quantitative data, expected returns, so on and so forth. And it's the same thing casinos do. That's why they're called the house. They can build a lot of big buildings with all the profits they make, because why? Well, you bet on that green for 38 times, you bet $100. Statistics show you're going to lose $200. That's $5.26 on average is your loss per spin, and that's the house edge. So your losses become the house's wins, and they'll gladly have you sit there till the end of time, because they're going to make that amount off of you over a long period of time, even though they will pay you to win, pay out winnings at times. On a long enough time curve here, timeline, they're going to win from that money from you. So how can you be the house when trading options? Well, let's see if we can do that here. Using a baseball analogy, how about higher probability or base hits. Remember, what's a more likely event, a grand slam or a single making it to first base? I think we all know the answer. So we're going to look at these higher probability types of option strategies and how to use our technology. So these are what we call base hits when we collect premiums by going short or selling options. We need to be consistent and patient when we do this, and we need to manage that risk because there will be losers, folks. If anyone says they have a, 98% track record, they don't. And maybe for a short period of time, but anyway, I won't go into that. So higher probability option strategies, you need to manage that reward. Don't get greedy. And you need the proper tools to make this happen because there's a lot of moving parts and a lot of variables when you're trading options and spreads. Remember, base hits, let's not swing for those fences. So these are short option strategies or premium collection. You can do this with non-directional bullish or bearish markets. And these are higher probability outcomes with predetermined risks. That's what we're going to focus on. We're going to focus on these non-directional strategies. So we're not trying to pick market direction. And these are credit spreads where you collect premium. So everyone's that's buying an option, they pay the premium, and where does that money go? Well, it goes into your pocket. So you can be the seller of an option just as easily as a buyer. You have an as the credit spread, predetermined risk and reward, and they can be non-directional, and that's what we're going to focus on. There's a large margin of error, and don't worry about this graph right now. I will explain it in just a moment. But you'll see here the stock market moving back and forth, and you have this upper boundary and lower boundary. So it's a very wide margin of error, wiggle room, highly technical term. And Greeks, okay, so we can get deep into the weeds on Greeks and go into Vega and Rho and all these multiple derivative upon derivative of the Greeks, but we don't need to for our purposes, and that's the way we designed it purposefully for to avoid that type of thing where you get caught up in the weeds. So all we're going to look at is delta, and let's explain that real quickly. So the secret to delta, if you don't already know, it really represents the approximate probability of expiring in the money. And what do I mean by that? Well, if there's a delta of 0.25, it means there's a 25% chance that option expires in the money. But here's the key. You can see the yellow highlight there. That means there's a 75% chance the option expires worthless. Also remember that delta is always static, or I'm sorry, it's always moving with price and time. So it's not a static number, it's always moving. And it does not represent the probability of a winning trade. So don't make that mistake either in conflating that. Now there's also theta, just the only other delta, the only other Greek that we're going to talk about. So that's just sensitivity to time decay. Remember, options have a limited lifespan. So you refer to theta as time. It's a negative number, 1 day of time decay. So if an option's at 10 points and theta is negative 0.05, the next day after that, the premium would slip to 9.95, and after that 9.90, and so on and so forth, simply due to theta decay, all other things remaining equal, of course. So here's what it looks like on the graph. You'll see as we get approaching and getting closer to time zero, the percent remaining to that premium will drop and drop and drop and starts to really accelerate in the last month or two of the options lifespan. So what about selling a call spread? Here's a quick example. Look at this upper boundary here. The 3530 call, the red line, is the one we're selling, and you collect 4.5 points in this example. At the same time, you buy a 3550 call and you pay out 2.25. But the net result is you collect a net of $112.50 minus your commissions. So that's simply selling an out of the money call spread and doing the same thing on the puts. You sell this out of the money put spread below the market and you collect that net premium of $100 in this example. Now remember, these are not naked options like this poor, looks like a lab mouse there. These are always insured. So your maximum risk is capped, and that's what's called a covered option spread. This poor cat here needs some fur. And remember, we're talking about covered spreads. Now, if you have people telling you to trade naked options and sell naked options, don't. I've been doing this long enough to know that it's not worth it. It might work for a period of time until it doesn't, and then you'll give everything back. So you want to avoid that type of feast and famine trading and those large drawdowns. And here's another couple, really the big advantage. When you're trading naked options, you're going to end up on margin call a lot. Even though you don't think you will, you will. I promise you that you will. And you're going to end up having to add money to the account or closing out your positions. And so what happens is the market ends up trading you, and you want to avoid that. You don't have control at that point. So with that said, we're going to look at an iron condor, and it's just a combination of the put and the call spread. Then real quickly here, here's what it looks like on a graph. So some of you may already know about this particular strategy, and that's fine. But we're going to look at a variation on that. But real quickly here, you're selling an out-of-the-money call spread here, collecting the premium, and simultaneously selling an out-of-the-money put spread and collecting that premium as well. And you look for the market to stay basically in that range there. Now here's a variation on the condor. It's kind of a weird strategy, higher probability strategy, and we call it the dragonfly. So we came up with that name a few years back, and it's stuck, so we like it. People seem to like the name. It seems to fit. What the heck is a dragonfly? Well, it's a non-directional. Let me run you through that here with a quick look. So you'll see here the red line is a 40-60 call, S&P 500, and you would sell 4 of them further out of the money calls and 1 closer to the money call. And I want to point out that the one you buy here, this one that's closer to the money, in this example is 50 points closer to the money than the 4 you're selling. So the delta is greater, and also it will lose time less quickly. Theta decay won't impact it as rapidly as the further out of the money calls that you're selling. And the same thing here with the puts. We're selling 4, buying 3 further out, and 1 closer to the money. So it's this structure, this 4-3-1, 4-3-1 structure, and that would be 1 dragonfly. But here's the thing that kind of boggles people's mind is, where would you even start in constructing a dragonfly? How would you even know which market to start with? What strategy to apply? How do you know the pricing? How do you know what strikes to pick? The expiration? How do you know the timing of the entry? How do you manage your risk and reward? So there's a lot to consider if you're going to do a strategy like that. Call it a complex option spread, multi-leg option spread. So the answer is ThetaTrader. These are pre-built option spreads generated by ThetaTrader, and those are some of our floor traders down there. Great group of guys that were executing options trades for us. And so our algo is proprietary to us, and it will automatically create what we call theta trades. So every day you'll be presented with theta trades, and I'll show you that. So basically you have this strategy automation component to ThetaTrader. We talked about bull bear, and of course non-directional markets, not necessarily flat, because markets aren't, I guess it's all a matter of perspective as to how you want to use the word flat, but let's just say a range bound market. And then you have the automation with the risk and profit tracking on the risk thermal indicator. So here we go. Let's look at ThetaTrader a little more closely. Simple and effective option spreads and profit and risk management is what we're talking about. And let me see if I can switch gears real quickly. Or maybe I'll wait just a minute and look at some simulations. Yeah, why don't I just wait a minute on that? Because I'll show you in a second, but here we go. Here's the dashboard for ThetaTrader. So this is what ThetaTrader looks like, the dashboard. You'll see this section here are the theta trades, and these are your open short option spreads and any long or bought positions. So You can buy options with TradeOutLoud, but that's just not what it's really designed and built for. We think that's not really a higher probability outcome. And you'll notice here, there are bullish, bearish, and neutral or non-directional strategies or tabs. So if you click any one of these tabs here, it would populate all those additional strategies. And we're looking at the ES here, the E-mini S&P 500. Then you have available the NASDAQ 100 and the Russell 2000. And we'll go ahead and show you what it looks like if we were to look at the Condor. So you can see here we clicked Condor, and now these are the pre-populated spreads that TradeOutLoud generated, anywhere from 16 to 60 days till expiration. And all the strike prices are maximum profit potential at expiration. And this is your targeted annualized return. But keep in mind, this number here is not realistic to expect you're going to get that type of annualized return from any of these trades. These numbers here are simply to compare one condor to another. And of course, you notice the ones with the least amount of time are going to have the higher annualized return. It just assumes you're turning that trade over 16 days at a time and making the maximum profit every time as well. So I just wanted to point that out. But you'll see here all the different pre-built condors available. And then what would be the next step? Well, you would choose one of them. Let's choose this one here with 60 days till expiration. The September monthly. And you'll see here, this graph gets pulled up here. And before we go, I want to show you, you click on the here for chart and you'll get a graph, an overhead view. You can see here's the current price. So we're selling this out of the money call spread and out of the money put spread and collecting premium on that. So let me go back to this table here. And I won't go through every category, but let's just hit some of the high spots. So you'll see the cash required, almost $900. And that basically covers the maximum risk on the trade. So here's your profit potential here of a little over $100, targeted return on cash about 11%, and then your targeted annualized return. And you'll see here, these fields are already pre-populated by the algorithm, and you can note that the deltas here are given to you, and you'll see that, for example, the put that you're selling, the delta is 9.76. So what does that mean, folks? It means there's over a 90% probability that put is going to expire out of the money. So that's really the higher probability outcomes that we like. And the same thing with the call, 6.83% delta. So that would be 93% or so probability this call here is going to expire out of the money. And because you're selling premium, you're selling a condor, it always pre-populates it as a sell. You can buy a condor as well, but in this case, it's a sell. You can increase or decrease the quantity here, and that would change your cash required and so forth. And then the value is already calculated for you. So the pricing, the strikes, the expiration, everything is calculated for you. And when you place that order, I'll show you what happens. In fact, I'll just go back there. You would just touch place and I'll show you what happens in a second. But first of all, let's go back to the Dragonfly. Remember, we were just looking at the Condor. So let's look at a Dragonfly on the E-mini S&P 500. We'll look at the September end of month Dragonfly. And here's the matrix or the graphic here, the table. And you'll see that the cash required is just over $4,500. That's because you're selling 4 puts and selling 4 calls. And once again, you have those higher probability options. The same options that were on the Condor are also applied in this case with the Dragonfly because it's the same expiration. Oh, I'm sorry, actually, you know what? That's different. I apologize, that's different, not the same expiration. So there you have it. That's okay. If a different expiration, you're gonna have different strikes. But you'll notice that pre-populates as a sell, quantity of 1. The value here, you're collecting just over 10 points per Dragonfly. If you wanted to increase the quantity, you could, and then you would go ahead and hit place and place that order. If you want to look at a chart of the dragonfly, this is what it looks like, sort of an overhead astronaut view. What's it, a Branson and Bezos view, right? Astronaut view. And that's what it would look like. And once again, if you hit place here, then what would happen is you'd see it showing up in your orders, just like the condor and the dragonfly. You can see here we placed that dragonfly and that condor. Now, let me show you a really, really great feature. I'm going to switch screens here if you don't mind. All right, folks. Want to make sure we're on the right screen. Yes, we are. So if I'm not on the right screen, someone will tell me, but you should be looking at this E-mini S&P end of month January 2020 Iron Condor. This is our trade simulator. I have to kind of turn my head here, so don't mind me on the camera. Otherwise, I can't see what I'm doing. Okay. I'm going to go ahead and scrunch this down just a little. So this is a trade simulator, and you can backtest all these condors and dragonflies. And I think this is a very unique functionality and feature to ThetaTrader. And let me show you how this works and how the RTI works. There's a play button, and you can watch the market. This trade started on November 20, for example, with 73 days till expiration. And this is the January end of month Iron Condor. So this would have been a theta trade available on the platform on November 20, 2019. And let's see what the result would have been. We'll press the play button, and I'll stop it in just a second. So you can see as you go by day, the P&L in the trade is going a little bit negative, a little bit positive, and that's normal. And the RTI is green. So that means do nothing. You don't need to change anything, do anything, and let the market do its thing. So now it turned yellow. See that yellow? Slightly elevated risk, but still you don't need to do anything. The trade's taking basically a little bit of pressure because it's moving close to that upper boundary a little bit too quickly. And then look at this, it turns red. And what does that mean? That means you have a loss and get out of the trade. That's your risk-taking basically line in the sand, the red line in the sand. Now, let me make this point clear here, and I'll repeat it a few times. This can be automated, and I'll show you how to do that. But if you have a condor and you place the RTI will automatically track, monitor that position, and then close it out for you whenever it turns red, meaning there's too much risk, you take your loss, or if it has a profit-taking signal, and I'll show you that in just a moment too. So you can see here, too much risk in the trade, get out of the trade and take your loss. I mean, you're right there on those short options at that point. So theta decay worked for a while. You can see here as it was green. And of course, it's always working, but in this case, the market moved a little bit too quickly and also too much in magnitude. Now, I want to show you here a dragonfly. Now remember, this is the September end of month trade, and we placed it on November 20. So here is November 20, the same day. We're using the same end of month January expiration. Instead of a condor, we're going to do a dragonfly. So what do you think is going to happen? I don't know. Let's look. Well, I kind of do know, but I can't quite remember. I do bunches of these simulations all the time. But so you can see right away the profitability of the trade is turning greater at a quicker pace. You can see right away the difference there, and it's all green so far. Do nothing. And look at this, it turns blue. And what does blue mean? Profit-taking signal. And you can automate this. So when the RTI turns blue or red, the orders to close out that position will be automatically generated and then placed for you on your behalf. You do not have to screen watch and hover over and babysit your trades here. So you can see here that in this simulation, the Condor ended up being a losing trade, yet the Dragonfly on the same day, on the same expiration, was a nice winner. So we'll look at a few more simulations, and I can just go right to the end of these here. So here's a Condor, and you can see it was doing well, but then once again, the same kind of thing. Orange, elevated risk, ended up taking a loss here with only 2 days left. So right in the last at the last moment. In the month April 2021. So comparing apples to apples, in the month April 2021, instead of the Condor for that same expiration, we look at a Dragonfly. And look at this. The Dragonfly actually turned profitable with 38 days remaining in the trade, had a blue profit taking signal, and then issued even more profit taking signals several days after that. So really, you're only in this trade for 2 weeks or so, a little over 2 weeks before it turned profitable. So compare that to the Condor that we just saw that actually never reached enough profitability for the algo to trigger a profit taking signal. So that's one of the reasons we love these Dragonflies. Let's look at a couple more. Here's a Condor from November 2. Just go right to the end. And you can see here, this trade took a loss here with 30 days till expiration. The market ran quickly up. I remember that era. Now, see if the Dragonfly made any difference. And I don't want to be accused of just showing winners. So I think I'm going to show you that, just because you have a Dragonfly doesn't mean you're impervious to losses either. So here's the same date. Instead of a Condor, you did a Dragonfly. And once again, just like the Condor, you ended up with a loss on that trade, even though it was a Dragonfly. Yes, you are still selling premium, and yes, it is covered, but of course, there's always risk in any trade unless. So I just wanted to point that out. The Dragonfly is not, going to always keep you from losses. Let's look at a Condor real quickly. In fact, I just got a message here. Hopefully everyone can hear me okay. Something about my audio, but sorry about that, folks, if the audio is bad. Let's look at the Condor here, January 2. So that's an interesting one. Let me show you what happened here. You had a signal to get out, take your loss on February 28th. So you take a loss there on the Condor, February 28th. But look at this. Let's check in with the Dragonfly. Turns yellow, slightly elevated risk. And look at that, it turned blue. It gave you an opportunity to take profits and avoid the loss that the Condor had. And maybe one more here, and then we'll move along, and I'll show you one of the best features of all. So here's a Condor on May 1st. And you'll notice slightly elevated risk here as it turns orange. Now, remember, if you're trading this and watching this day by day, and you don't have an algorithm or a process or a methodology, you're going to be really lost. It's going to be difficult, just like with any trade, to really manage that risk and reward. But you can see here as time went by, this ended up being a winner here on June 24 with 7 days left. Let's see here, folks. I'm just getting the message. And I'll try to get back to some of these questions. I have a few chats and questions coming in. And now we're going to look at the Dragonfly. Compare that Condor we just saw to the Dragonfly. And look at that, turns profitable on May 28 with 34 days remaining. So you're able to take your money off the table and run and apply it to a different trade and turn that trade over, in this case, much more quickly than a condor. That'll happen oftentimes. So that's why we love the Dragonfly. We like that trade a lot. Now let me show you here on the settings here. You would go right here, and this is how you would automate it. You activate the risk manager, click that checkbox and the profit directive. That's all you need to do, and then save your settings. So that's how easy it is to automate the risk thermal indicator. And not only can you see your open positions on your dashboard, but of course you can go to a separate page and see everything on the same page. Let me pull that up for you. Okay, so you'll see here, there are on this page 8 short positions, 1 long position, and it'll give you kind of a summary, but you can see the RTI here is signaling do nothing, nothing to do with any of these. Sitting on some small losses with these current spreads, and that's completely normal when you're selling premium, because once again, theta decay takes time to work in your favor. When you first sell a spread, it's going to be a little bit negative for a short period of time, just because of theta decay not having a chance to really work its magic. And if you want to look at any position in depth, you can just click on it. So I clicked on this one here, the 3570, 4610 Dragonfly, and here's what it, well, actually that's the one I just placed. So that's why it's not going to show any history. Here, let's look at this one back from June 30. So there you go. That's a good example. This is the day you placed it, June 30. You can see it's been a little bit underwater, but still green. So again, it's sort of counterintuitive, like, well, if the trade's underwater, why is it still green? Well, that's how selling premium works. That's just the magic of theta decay. But you negative decay is working perfectly, and odds are that that trade will work out. Now, closed positions. This is where you find your closed positions. I'll wrap this up real quick and jump into one last bit here that you're going to love about Theta Trader. So you can filter for the date or by the market or date range or whatever you want. But here's everything on the closed positions. There's 20 closed trades on the page. Just happens to be 20 winners and 0 losers. And here's your total P&L, 17 short options or short spreads, and then 3 long ones. Of course, this is just a demo account, so I wouldn't make too much of that. But generally speaking, most of the options that you sell and spreads are going to have that higher probability outcome in your favor. So if you have a window of time where the market's cooperative, you can end up with a lot of winners. But of course, the market can get volatile, and like we saw, just because you have a dragonfly, it doesn't mean that it's impervious to losses either. The idea is, though, you need to manage those losses, and you can automate it. So that's really the whole benefit here. Okay, so that's how you find your closed positions. Let me point out too, we have research. We do something called TradeScope every day. We provide some technical analysis on the S&P, NASDAQ, Russell, and we give sort of a market outlook, what to expect. And we also do a narrative, going backwards, when I say backwards in time, just looking at what happened that day. So you'll see what happened in Asia, Europe, and the US, looking at the economic calendar, looking at any outlook here. So we do that every day as well. And there are video tutorials here to help you through the platform, but it is very intuitive and user-friendly. You probably don't really need that. Most people don't. Education, if you want a little background on some of what we talked about today. So some videos there as well. And again, you saw the simulator, and that's how you reach it right here. I won't go into it, but just kind of pull it up real quickly and you can get an idea. So you can go backwards in time and back test. So you can see, you can go backwards in time, pick the day, the month, whatever, and then you can run any of the strategies by that by this mechanism here. So with that said, I think that's covered the dashboard. Let me do something here. Let me switch screens real quickly. And I'm going to show you, I think probably the best feature of all. That was the simulator we just saw. I know, it kind of reminded me, someone kind of gave me this idea that after they watched one of these presentations, they thought, wow, that's a lot to take in at once. So it reminded me of Lucy and Ethel in that chocolate factory scene. I don't know if anyone thinks that's funny or is it just me, but okay. So here it is. How can we make this easier? I think we can. Trade alerts. 1 minute trade alerts. In fact, it's more like 1 second, and I will explain that. These are one-touch responsive alerts. All you simply do is touch accept or reject on your smart device. And that's all you have to do. You don't have to log in to a platform. You don't have to copy an alert from some email or text. None of that nonsense. I do talk to people every week and I hear a lot of the same stories. I did a buy versus sell. I made a mistake on my entry when I should have exited. Whatever. And it cost me thousands of dollars. Can you help me? It's like, well, I can help you in the sense that we offer these trade alerts and you won't have that problem because these are live alerts, meaning they're integrated with your trading account at AltaVest. So again, you receive the alert, you touch accept, and the order is placed for you in your AltaVest account. It's just that easy. Let me run this through, and I should probably get a different video at some point soon that maybe zooms in a little bit further, but I think you get the idea. You would receive a text alert and you just touch the link and it takes you to the alert. And you'll notice, I'll pause it here, you'll notice the graph telling you what the trade is. You maybe can't see it, but it has your account and it has the size of the trade. So it's already pre-sized for your account. So the quantity and everything is already appropriate for your account. And that's because, of course, it's aware of what's in your account. The technology does all that. And if you like what you see, you just touch accept, and that's all there is to it. Watch it one more time. Okay. Couple questions real quickly. Defining risk is the put risk. So any of these spreads that we're selling, what's the maximum you could lose if the world ended and the stock market went to zero? So that is the put risk is how we use that to define risk. Yeah, and the dragonflies, people have them, they call them all, broken wing, half wing, deconstructed butterflies, and they call them all sorts of different names, reverse backs, or I mean, I'm not even sure what they call them, but there's different names people have come up with for the dragonfly, but we just call it the dragonfly. And someone asked about the custodial firm. Well, we are the brokerage firm. And so we're the introducing brokerage firm and our accounts are introduced. The custodian or the FCM is RJ O'Brien. So we trade with RJ O'Brien, if that answers the question. They're over 100 years old out of Chicago. So let's get you started here on how you can get into a Theta Trader membership. I don't want to take up too much time or go over. I think I've got maybe 10 minutes or so if I'm looking at my clock correctly, maybe 15. Okay, so you get Theta Trader software, of course, the proprietary algo that creates those option spread opportunities, simple, effective trade selection. The RTI, it's our favorite indicator, automatically exits your trades. Basically put your account on autopilot. Once you have a trade placed, you don't need to manage it. The RTI will do that for you. Take your emotions out. You have that trade simulator. We saw several simulations. It's a great tool. People spend a lot of time with that. It's actually kind of fun to use as well. So you have the theta trades, the RTI, and the simulator. That software valued over $3,500. Then, of course, you saw the one-touch trade alerts. Those are all integrated with your account. And remember, you touch accept or reject, and that's all you have to do. And then once a trade is filled, ThetaTrader will track it, monitor it, and then the RTI can automatically close it out when it reaches a risk or profit target. Those alerts are valued over $4,400. I do talk to people and they spend a lot of money on these types of services. So maybe some of you are as well. So you have ThetaTrader and the alerts, over $8,000 value. And I won't beat this to death, but I do want to make sure everyone's clear on what we're offering, because some people say, well, can you do that again? And you also get to tie it all together, a coach. So you get to work with someone, a live, real person, a breathing body, Series 3 licensed, experienced trader. They'll do 1-hour screen sharing sessions on any topic that interested in, to help you along the way. So really, I think having that co-pilot is really invest. People are spending, I talk to them, I've worked with them, 25,000, 50,000 on education programs. And that's okay. Nothing wrong with that. But what we're saying is we include that with your ThetaTrader membership. We're a completely different type of structure than an online brokerage firm. So we have that ThetaTrader membership with the software and the trade alerts and your private coach who's there available for you if you need the help, valued over $15,000. And then to get a little corny, there's, don't forget the extra bonus, of course. And just don't forget we have that proprietary research with TradeScope and the commentary. People love looking at that every day as well. Then we have those online tutorials. Those are of course available within the platform should you need them. But really, the ThetaTrader membership valued over $18,000. The software, the alerts, the coaching, the research. So we think it could be worth it for you. You'll have to decide that yourself. But if you're on the fence, I'm going to give you an offer here that you probably can't pass up, as they say, an offer you can't refuse. I think it could save you a lot of time. You can cancel other subscriptions perhaps and lower your stress. I think it could be that one thing that works for you. And yes, it's true. People do pay tens of thousands for trading software and alerts. And I talk to them and I've done it. So I understand. Boy, have we done it. So we we know exactly where you're coming from. ThetaTrader membership, 1997 is what we've offered these in the past. We used to do live presentations and people run to the back room and sign up. But we can do a lot better than that. These are online webinars that we're doing. And because you're here live, we're going to offer this at a huge discount, 70% off our retail, $597. And that's a one-time payment. I want to stress that, one time. So you pay once and that's it. You're a lifetime member, and we've been doing this since 1997. And here is the link to make it happen, cf.altivest.com/TT. There's our phone number. No one answers right away. That's because I'm on the phone here. That's my direct number. I sometimes put a different number and then it goes to voicemail or people hang up because it's a voicemail. So either way, leave your message. But $597 one time. Now here's the thing. There's no excuse, folks. Guaranteed. So 30-day. If you don't like it, we'll give you a refund. If it's not for you, it's not for you. We're not going to hold you hostage. It doesn't work like that. And a few FAQs, futures and options are tax efficient. So here's an example. I won't go through every detail. You're trading individual stocks, 100%, $100,000, make 20%. You'll pay 12.6%. You'll receive 12.6% return after paying tax. But trading with of $100,000 going to 20% return, 14.64%. These are tax efficient. You have a 60/40 IRS code. Was it section 2? I forget the section, but anyway, only 60% of your gains are taxed at the more favorable long-term cap gains rate. So No more itemizing as well. That's a pain to itemize all those stocks and wash trades and securities. You just get one number at the end of the year. This is your profit for the year, and that's it. That's all you get. Now, FAQs, why trade E-minis? Well, they're liquid, they're efficient, and they're cost effective. And a mini can be huge. It's 2.5 times larger than all ETFs around the world. The E-mini S&P 500 market. So think of that. It's probably something you hadn't heard of before. So the largest size, look at this here, 6,600 ETFs around the world, and the E-mini S&P is 2.5 times greater than all of them combined, 10 times greater than the SPY. So this is the right market, folks. If you're not in this market, you're I don't know, kind of in the, what do they call it, the bush leagues, minor leagues. And I'm just kind of teasing, but really, this is the market you want to be in. Large volume, liquidity, access. Look at this from, I think, in May or March, almost 2.2 million average daily volume on those E-minis. Superior execution, cost savings of $4 to $15 per contract on those ES options, according to the CME group and their study. So that means you have a tight bid offer spread. And then the dragonflies. Remember I mentioned the dragonflies, it's kind of not possible to do it in other markets. Well, here's why. We have a different structure when you're trading futures options on these markets, completely different when you're trading securities options. So we can take that order of 6 different options, 6 different strike prices. It gets placed as one package or one object is what they call it. The technology at the Globex handles that as one object. And in stocks, I've tried to do this with the dragonfly and it doesn't work. You have to do a condor first separately, then you have to build a separate spread to kind of fill in the blank missing part of the trade. So you have to leg in, you have to build it, try to find the strikes, try to find the pricing. It's just it's a mess. And then how do you manage it? You can't automatically manage it. You don't have the RTI. So there's densely packed strike prices, 100 annual expirations. That's called granularity and coverage. What does that mean? That means when our algorithm is searching for strike prices, it can find them. That's what it means. You try to find deep out of the money options on some other securities and you're not going to find them. They don't exist. Remember, you're tracking 1 or 2 markets, not thousands. Efficient margin use compared to stocks. There's a clear cost structure. What am I talking about? These are not securities options, so there's no hidden cost. Everything trades on one exchange at the Globex, so every order is treated equally. There's no payment for order flow nonsense. I'm going to beat up a little bit on some of them. Robinhood, it's not commission free, folks. They're getting inferior trade prices, costing customers tens of millions. They're paying fines, $65 million fines, because they're not transparent. You're saving a penny to lose a nickel is really the way sum it up. So if you want a broker to work for you, pay a commission. David Einhorn, big money manager, hedge fund. Payment for order flows, disguised commission. So you're trading with your brokerage firm, and we all have brokerage accounts at a stock brokerage. That's fine. But the point is, it's not free. It's not free commissions, folk. Robinhood just got a $70 million FINRA fine on top of their SEC fine. So nothing of value is truly ever free. I think that's a fair statement because people are going to want to know what are the commissions. 5 1/4 round turn all in. Our rates are very competitive. So here's a screenshot right here from a big box brokerage firm, and it says they're 225, but it's per side, and then they add clearing and exchange fees on top, and it's even higher than what we charge. So the point is, it's competitive. Yeah, other places you can find rock bottom rates, but you'll never get to talk to a real person, and they don't have Theta Trader and the alerts and on and on and on. So remember too that all the calculations in Theta Trader are net of trading cost. I should have said that in the demo, but everything is net of all trading cost. And performance of Theta Trader, everybody's different, of course, because they all trade it differently. And what size account? Well, if you want to do multiple option spreads, we suggest at least 25 to 50,000. And in fact, a lot of people like to take us up on this offer, $100,000, and we'll just rebate that membership fee. So you're more than welcome to do that. An IRA, individual, joint, corporate trust, all the usual characters there for type of account. Self-directed IRAs diversify a portfolio by adding investments with a low correlation to stocks and bonds, control volatility and limit downside risk. So we like the trading style for a portion of your IRA, but there are some financial and experience requirements you'd want to ask us about. So here may improve diversification, lower portfolio risk. I think that's a fair statement. With alternatives, you don't want to always just have to buy stocks, and that's all you do. It's not going to work unless you just buy a passive index fund and do nothing. Inflation, Fed monetary policy blowing a bubble. I don't know, probably. But here, CRB index. Let's let the data tell us. Here's commodity prices for the last year. You tell me. And the Fed says there's no inflation. 1 year expected inflation here. Look at this, just spiking up near 5% now. Consumer prices surge in June, the most since 2008. Used car prices skyrocket, breaking a 10-year record. Look at the price here. Yep, no inflation, folks. Not according to the quotes experts. And look, your car is expensive and so is the gas. So the 3 blind mice here, they don't see inflation. Nope, not seeing it either. And look at this here. We're going to wrap it up quickly, but here's the S&P 500, but really you have 20 stocks contributing the majority, almost the majority of the domination in the S&P 500, the return. The rest, the 480 remaining stocks are here. Look how dominant these are. And here's another chart. The top 5% in the S&P 500 make up 22.4% of the index in terms of percentage of the market cap. So, you know, if you think you're diversified, trading the S&P 500 and buying it and holding it, you know, maybe not so much. Nothing wrong with having shares of stock, but we like the idea of having something, an alternative that's non-correlated. You have those non-directional strategies, really something unique. Here's your portfolio here with stocks and bonds, and then that slice of the pie there with alternatives. We'd like to be a part of that. So we'll wrap it up here with the Theta Trader membership. Just a brief review. You get those pre-selected spread trades, auto trade exits with the RTI, and then you get that integrated one-touch trade alert functionality, and then to tie it all together, that personal coaching. So that is a great offer. End up here with a little humor, hopefully. I don't think you want to trust your gut. That's not going to work, folks. You need a process. You need a methodology. You need a repeatable approach. And I think that's what Theta Trader can offer you, that automation, that element that'll help you trade in a way that you really otherwise couldn't trade. So there you have it. Lifetime membership, one payment, $597. And that's good through the weekend, that discount. If you have a comment or questions, you're always welcome to call us as well or send us an email. And someone actually mentioned Canadians. Unfortunately, we can't open accounts with Canadians unless you have a legal U.S. residence. I wish we could. We get that same question all the time. Okay, and if there's any other questions, feel free to ask. Otherwise, that is all I have for you today, folks. I welcome you to call me and reach out anytime, send an email. We're here and we can help you get started with Theta Trader. So thanks for the time.